Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Tuesday, 4th November. Coming up on the show, stocks across the world stumble as correction fears mount. We have big news on Tesla and its shareholder vote on Elon Musk's proposed $1 trillion pay package. And an exclusive this morning, I'll be talking to the CEO of Cognizant. He's just announced a big AI partnership. But before we start, some breaking news. Former US Vice President Dick Cheney has died at the age of 84. His family said he died from complications of pneumonia and cardiac and vascular disease on Monday night. Cheney served as President Gerald Ford's White House Chief of Staff in the 1970s before spending a decade in the House of Representatives. Well, the first thing you need to know is that global markets have been stumbling today and Wall Street is set to open lower too. Just look at the tech giants in the pre-market this morning, all in the red on valuation fears, and futures aren't looking any better. Across the world, we've seen record highs, but both Goldman Sachs and Morgan Stanley say we should be braced for a drawdown over the next 2 years. Goldman CEO David Solomon told a summit in Hong Kong that the drawdown would be somewhere between 10 and 20%. Meanwhile, Morgan Stanley CEO Ted Pick said investors should welcome periodic pullbacks, labelling them healthy developments rather than signs of a crisis. One stock feeling the impact of the sell-off this morning in the pre-market is Palantir. Its shares are down over 7%, despite the company raising its annual revenue outlook overnight. The next thing you need to know is all about the politics that Wall Street is watching. The current government shutdown is set to tie with the longest ever one we've experienced later tonight. However, Senate Majority Leader John Thune said he was optimistic about ending it this week and that the upper chamber would take its 14th vote on a House-passed funding bill today. Meanwhile, President Trump has weighed in on the New York mayor election. He's backing Andrew Cuomo, who lost the Democratic nomination to frontrunner Zoran Mamdani. The president also said he would be reluctant to send more than the very minimum level of federal funding to the city if Mamdani wins. And the final thing you need to know is that there's been an interesting development in the Tesla shareholder vote on Elon Musk's proposed $1 trillion pay package. Norway's sovereign wealth fund, one of the EV's top 10 shareholders, said it will vote against ratifying the CEO's pay deal at this week's annual general meeting. Well, our senior autos reporter Praz Subramanian has more on what else will be scrutinised this Thursday at that Tesla meeting.
The $1 trillion day is coming up on Thursday. It's the day of the general meeting, so we'll hear about the results then. Tesla chair Robin Denholm has been out drumming up votes for Elon's pay package, which is, a little unusual here, claiming that shareholders need to reward and motivate Elon to build things like AI at Tesla, like Dan had mentioned, the big AI play, right? Or Elon says he might take his ball and go home. The question is, should shareholders believe that? And I think there could be, maybe there's a better way to give control of Tesla without what could be $1 trillion pay package. That's the big question here. I want to note a few other items up for vote. 3 board members, Ira Edenprice, Joe Gebbia, and Kathleen Wilson-Thompson are also up for vote. And also XAI investment. Elon has said that he wanted to put that to the board members. A shareholder has submitted that proposal. So the board is not making a recommendation, but there could be some sort of investment potential made there between Tesla and XAI.
Okay, we're heading for a short break now, but stick with us as Ravi Kumar, the CEO of Cognizant, joins us live on Market Sunrise. Welcome back. Well, in recent days and weeks, I've been telling you all about numerous AI tie-ups, and this morning is no exception. Cognizant, the professional services company, has agreed a deal with AI startup Anthropic. Cognizant will roll out Anthropic's Claude AI models to its 350,000 employees. In fact, this deal makes Cognizant one of Anthropic's 3 largest customers. Well, let's look at this deal in greater detail, and who better to do this with than the CEO of Cognizant, Ravi Kumar. Ravi, thank you so much for joining us on Market Sunrise. So can you tell us a bit more about the deal and how it came about?
Thank you, Ramzan. Thank you for the opportunity. So here is what system integrators like us do. Over the last 30 years, we built services around the software development cycles. and we wrote software code and we shipped it to enterprise landscapes. We did that on premise in for many years. Then we did it on the cloud, and I call it the elastic computing era. So this was all about what we did. Here we are in the era of AI, where we're starting to build services around the LLMs. I call it the contextual computing era, where the technology is not just an insights tool and a decision support tool. It's also a tool which can actually create digital labor. So the cloud models of Anthropic actually are one of the best in the world. They're trustworthy, safe, as well as they deliver to they deliver responsibly to businesses. So in the contextual computing era, as I call it, bringing the power of intelligence from the cloud models of Anthropic and the domain expertise of companies like Cognizant, so that we can apply this to businesses. So here are the two swim lanes on which this partnership is going to pillar on. First is writing software code. I mean, the single largest use case for AI is actually writing software code and assisting humans. We are the only company in our peer group which actually has audited numbers of what percentage of our code is written by machines. 30% of our code is written by machines. This is what I said in my earnings last week. And on this swim lane, we think we can actually deliver more software for less. And the paradox of doing more for less is, technology is so elastic that you're actually going to consume more. So we believe that throughput, that higher throughput, higher velocity, and lower cost of deployment is going to increase the amount of software we can actually write for clients. The second swim lane is about applying LLMs to enterprise businesses and business operations and creating digital labor, as I call it, or agentic capital, which is going to coexist with human capital, and actually it'll amplify the human potential. And we can reinvent and reimagine business process functions, business process workflows, and and business business landscapes. And as we go through that reinvention, we are going to see more productivity, new products, new services, which are going to be delivered, which are powered by AI.
But Ravi, you talk there about a lot of your code is now written by AI. Do your clients? I mean, you've got some huge clients across the pharma world. Do they actually know? Can they recognize this? Are they able to decipher whether
100%.
something is written by AI or something is written by a human? And does that impact on the how much you can charge them for the service that you're providing?
So, Ramzan, the way it works is when the code is written by machines, it's not production grade. You need human in the loop to complete the process. We have platforms which integrate the human effort and the machine effort, and it is delivered to our clients. So, the point is, it is not about just delivering code from a machine. It's also about integrating human effort and taking it. We do 30% of our code and our software development cycles are impacted by, are impacted by machines. We integrate it with the human effort and then we deliver to clients.
Now, Ravi, you say it feels like you're setting yourself up now really as an AI company, but you are a professional services firm at the end of the day. So what makes you stand out from other professional services companies that offer similar type of services and products?
Ramzan, I actually mentioned in my earnings last week that we are an AI builder company. We have transitioned to an AI builder company. A AI builder company is one which is actually reinventing and reimagining business process with the power of technology. The reason why I call ourselves an AI builder company is, remember, there is billions of dollars, 400 to 500 billion dollars of AI infrastructure which has got established. And that value has to drift to the front to enterprises which can actually leverage it. And that's where the value is. So we actually navigate the journey for our clients. And as an AI builder company, we just don't have capabilities which are AI related. We actually layer capabilities with platforms which build the last mile infrastructure, which is actually needed for our clients to embrace AI. Though that last mile infrastructure kind of leverages the contextual computing era. Remember, this is a technology which actions, which means you need to weave the context into the LLMs or the frontier models. So we weave the workflows, we weave the data flows, we weave the execution patterns, and we weave the tribal knowledge into this LLM so that the agentic capital, which is built on the other side, is actually very contextual to the business you are in, to the culture you have, and to the workflows you have. And digital labor, in many ways, is much more than what classical software did. Classical software penetrated into businesses only to a small extent. The
Ravi,
surface area on which AI is going to operate is much, much more.
and Ravi, what do you say to the naysayers who say that AI spending may have gone too far, that these tie-ups that we're seeing are, just a bit of smoke and mirrors, that there isn't really anything concrete behind this?
There is a difference between the bubbles and industrial bubbles. This is an industrial bubble. An industrial bubble is good because the technology will endure, and the players who are in the mix may or may not be successful, but the technology will endure. Now look at what's being invested. Roughly 400 to 500 billion dollars is invested on the back end of the AI infrastructure. If you see the operating cash flow of the seven big companies which are investing into this, their operating cash flow is much higher. So the leverage, if you're looking for leverage for the risk of the bubble, they're not leveraged. It is predominantly from the operating cash, the funding of this infrastructure is. The reality is a lot of the implementation of AI is consumer-led AI. The moment you drift that value to business AI, and the bridge to business AI is companies like us, we are going to see a reinvention of businesses. And when reinvention of businesses happen, the productivity bump you're going to get is going to actually justify the extraordinary investments which have happened on the back end of infrastructure. Any technology disruption, you're going to see the infrastructure being invested first, then the services around it are going to be built.
Ravi Kumar, CEO of Cognizant, many thanks for joining us here on Yahoo Finance.
Thank you. Thank you for the opportunity.
Okay, it's time now for another quick break, but we'll be back with today's trending stocks, including a closer look at Palantir. Time now to look at stocks trending in pre-market, and there's a lot of concern today across EVs, AI, and even chips this morning. Tesla is hitting the headlines, and not for the best reasons. We told you yesterday that the monthly new car registrations plunged in Northern Europe, down 89% in Sweden from a year earlier. And now there's more bad news for Elon Musk out of Scandinavia. Norway's massive sovereign wealth fund, one of Tesla's largest shareholders, has confirmed it will vote against Elon Musk's trillion-dollar pay package. Tensions that have emerged between Norges Bank and Elon Musk mean the Tesla CEO needs to convince retail investors to back him in 2 days. Tesla's shares are down more than 2% in pre-market trading, and if Musk were to lose that vote, the consequences are very much unknown. Palantir is another big mover we're watching closely. The AI data analytics firm is falling about 7% pre-market, even after beating earnings expectations. The problem seemed to be guidance. Investors wanted a bigger boost in margins and AI revenue outlook. Some analysts will call it a sell the news reaction, showing how high the bar is for anything AI related right now, even for a stock that has been a big favourite of investors so far this year. Remember, the big question is this a pause in AI stocks' dramatic growth, or a sign that the bubble is bursting? And check out Iron, the Bitcoin miner turned AI infrastructure player. The stock fell more than 5% in pre-market after a huge rally yesterday when it surged on the news of a $9.7 billion deal with Microsoft. Today's drop looks like straightforward profit taking to me, like for many other tech stocks today. Iron has already gained more than 500% this year as Bitcoin miners pivot to AI data centers. And many other tickers are in similar situation today. Look at Cypher Mining, Lumen Technologies and Amcor Technologies. They're all down sharply in the pre-market there. But next up, I want to take a closer look at Advanced Micro Devices, which is reporting earnings after the bell tonight. The stock is up more than 160% in the 6 months, so some investors are clearly taking in some profits. They're down in the pre-market over 2%. Expectations are extremely high for AI chip sales these days, especially after Alphabet and Amazon Cloud's results last week. A miss or even a so-so guidance from AMD could trigger a big move after the bell. And finally, one typical meme stock move. Beyond Meat, the plant-based burger maker, is in free fall again. Minus almost 8%. It was down almost 16% earlier. Yesterday, it was down more than 7%. Again now ahead of the Wall Street Open. The clear trigger for the sell-off, Beyond Meat delayed its earnings release, saying it needs more time to calculate an impairment charge. That's adding to ongoing concerns about declining sales and cooling demand for meat alternatives. So, as you can see, there's a lot of red across the board today. Now, Amazon is in the news again, this time because of its huge deal with OpenAI. $38 billion. OpenAI will gain access to Amazon's computing power over 7 years, and it's the latest in a string of similar deals for the ChatGPT maker. Our tech editor, Dan Howley, explains.
This is basically kind of an extension of what we've seen in the past where OpenAI teamed up with Microsoft. They were using Microsoft's Azure cloud. This way, the infrastructure is already built. They don't have to put in for it. They just pay to rent the servers. It's the same thing here with Amazon, the same thing we also saw with Oracle. Now, just for some context, originally, OpenAI and Microsoft were linked at the hip. Microsoft was the #1 provider, exclusive provider for their cloud services for AI, but then they started to allow OpenAI to use other sources for their cloud needs. Microsoft just unable to really keep up with how much OpenAI demanded as far as capacity, and so they had a right of first refusal. That allowed Oracle to come in with the Stargate project. Now, last week, we saw OpenAI and Microsoft sign a new deal, basically cementing OpenAI's ability to turn into a public benefit corporation. And as part of that, Microsoft no longer has that right of first refusal. And so OpenAI is free to go and work with the likes of AWS. Now, this is a big deal for AWS because prior to their earnings and prior to this even, there was discussion of them falling behind perhaps in the AI race just because the fact that they didn't have a huge name customer like OpenAI. Yes, they had Anthropic, but they split Anthropic with Google more or less. They said that they're going to have 1 million chips for Anthropic. Google said the same thing. So this is an extension of all of those deals.
Okay, we've got some breaking earnings for you now. Let's start with Uber, and it's posted its strongest quarterly growth since late 2023. Customers have ordered more rides and deliveries than expected, but the forecast has underwhelmed and has sent shares lower. Much lower, in fact, in the pre-market. The company expects the momentum to continue as it heads into its busiest period, though, with fourth quarter bookings forecast of 52.25 billion to 53.75 billion. But again, that has disappointed investors, it seems. Okay, let's move on to Shopify. And results here have actually beaten expectations. The revenue easily beat estimates there. Operating margin also coming in roughly around 16%. The third quarter earnings per share at 20 cents as well. But Shopify is falling in the pre-market there, as you can see as well. Clearly not impressing investors enough. Shares, though, year to date, though, are up over 60%. Okay, next up, the world's biggest music streaming service, Spotify. Well, its shares were soaring in the pre-market after it said that monthly users had climbed 11% year over year. 713 million in Q3. That was actually 2 million more than analysts had been expecting. The Swedish-based firm said that revenue increased 7% to $4.9 billion. Again, another street beat. However, ad-supported revenues did decline. They were down 6%. Spotify said that was down to pricing pressure. Okay, let's move to the world of pharmaceuticals now, and Pfizer, and it's just reported revenue for the third quarter that in the main met average analyst estimates. It's also raised its 2025 profit forecast for the second time this year as ongoing cost cuts helped make up for slow sales growth that's driving its battle for the obesity startup Metsera. Now remember, yesterday it filed a second lawsuit against Novo Nordisk and the obesity drug startup Metsera just yesterday, doubling its fight to stop Novo's bid for the biotech by alleging the deal would violate competition laws in the weight loss drugs market. Okay. Now, here's a question on everyone's mind today, especially as markets are set to open in the red. Is the central bank going to cut rates in December? Well, Austin Goolsbee, president of the Chicago Fed, explained his perspective here on Yahoo Finance yesterday.
So to your point, Fed Chair Powell used the analogy of when it's foggy, you want to slow down, become a little bit more cautious. Is that a fair characterization for you? And how are you viewing the balance of risks? Fully recognizing that we haven't had official data on the labor market side because of the government shutdown. It sounds like you may be more worried about inflation than employment now when you look at the balance of risks.
I've been a little more worried about inflation than the job market if you think of it as a balance of risk, for the reason that other than payroll job growth, if you look at things like the unemployment rate or other rates that are less affected by population changes or immigration policy, those things have been pretty stable for some time. If you look over the last 12 months, the unemployment rate has not been going up. We haven't seen a big uptick in layoffs, which if this were the beginning of recession or deterioration of the labor market that was rapid, you would expect to see higher layoffs or firing, and we haven't seen that. There's still concerns on that side. And as you say, we're going to get some private sector data, so we can at least keep observing that. But I just want to emphasize, be very careful at moments of transition where you're trying to figure out whether the economy is turning. Relying too heavily on 12-month backward-looking numbers like the 12-month trailing inflation. Each month we get a number, and 11 of the months we already knew. The new information is only for that new month. So the fact that the last 3 months inflation is not going down but is instead going up, including in some categories that are not driven by tariffs like services, those are areas of concern. And so that's a little bit, the last time you looked out the window, there was a mountain lion sitting in your front yard. So before you let Fluffy out to go run around, just let's at least get one more look.
Okay, before we go, let's have a quick look at where Wall Street could open later this morning. And it looks like it's going to be opening firmly on the back foot after those warnings from Goldman Sachs and Morgan Stanley. AI stocks are getting hit particularly hard in the pre-market, as we said earlier as well. Okay, that is all we have time for this morning on Market Sunrise. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. Coming up next, join Julie Hyman ahead of the market open on Morning Brief. I'm Ramzan Karmali. Go own the morning.